Hello, and the live Q&A joined as always by Simon of Optimize Accountants and Richard Taylor, the founder of Plan First Wealth. We are, I believe, live on a few different channels today, so we may have some viewers who are not familiar with us if we just want to start with some quick introductions. Richard, you
Yeah,
want to
all
start?
right. Sure thing. So, as James said, I'm the founder and CEO of Plan First Wealth. We're a financial planning wealth management firm. We help successful British expatriates living across the US to make the most of their opportunity. We focus exclusively on the wonders of the British expatriate in America, and try and make sure we can perfect that and help them, as I say, make the most of their opportunity. And part of that is not falling afoul of the Byzantine idiosyncratic tax rules that is America. That then there's an additional layer where you're an expat, and that's why we brought in Simon.
Thank you. Shall I introduce? So my name is Simon Misiewicz from Optimize Accountants. We do deal with UK and US taxation. So it doesn't matter if you're British moving to America or Americans moving to the UK, we have you covered. As you know, Richard was saying, I am an EA as well as a UK ACCA qualified accountant and ATT tax qualified as well in the UK. So I see a lot of the issues that you're all facing. And the problem is whenever you get tax advice, normally you get tax advice in the country you're in. And that can be quite dangerous because you need the expertise in both countries. And it's really difficult when you're dealing with top four because they give you different interpretations or they have to hand you over to someone else. So it's really difficult to get the one answer that you're really ideally looking for. And hopefully that's what I can do, bridge that gap.
So true. That is so true. The different interpretations, it's a minefield. Just deciphering the differences between two different taxpayers with two different experiences and two different sets of knowledge and two different opinions, is a challenge in itself. Quick question. I know what ACCA is. I nearly did that in a past life. But is ATT the UK equivalent of the EEA, essentially?
Yes, in effect. So right. ACCA is more to do with the accounting and regulation compliance, where ATT is more about tax advisory.
Right. Okay. So to represent your clients in front of the IRS here, you have to be enrolled. Is that to represent clients in front of HMRC in the UK? Do you need to be ATT, or should you ATT or something like that? Like
most accountants will stick for ACCA only. They don't necessarily go for the additional qualification. But all of our staff members are ACCA and ATT. Just give the ATT focus on law, where accountants will focus on just pure numbers and look at it, financial reporting. But I think it's all to do whenever you're giving advice, you should know law, and that's why we do ATT, which is similar to EAs.
So that's exactly like that's exactly how they position the CPA versus EA here. CPA is about being an accountant. EA is about taxation law, and it sounds like that's the exact mirror in the UK is ACCA or ACA for accountancy and ATT.
I think that's a fair reflection.
Okay, James, sorry I hijacked that a bit. Do we need to do a disclaimer, or can we just...
let me start with a quick disclaimer at the risk of repeating myself for anyone who has been on these. Plan First Wealth is a registered investment advisor. The information presented today is for educational purposes only. Plan First Wealth does not provide any tax and or legal advice and strongly recommends that clients seek their own advice in these areas, hence today's session. The other thing I wanted to mention for anyone on, we do have prepared topics. We're going to jump into some common questions. We've got some questions that have been sent in since our previous Q&A. But if you are watching live, please feel free to send us any questions on your mind, anything related to cross-border US-UK tax, whether you're on YouTube, LinkedIn, Facebook. We're happy to answer those questions and comments as they come in. And without further ado, I think we can dive right into our first topic, which we were talking a little bit offline about this. Should we start with the famous PCLS?
Yeah. So go on, James. I reckon this could come up every single month.
Yeah. Yeah.
It's just so relevant,
Very
so
common.
pertinent. Everyone asks it. So go on. Do you want to expand on the question, and then we'll...
Yes. So in the UK, if you have a UK private pension, you might be familiar with a tax-free lump sum of 25% available to you from that pension. That is a mechanism native to the UK pension system. And when we say tax-free, we're talking, of course, about how HMRC views that. One of the questions we receive, as Richard alluded to, just about every week is, how does the US view the taxation of that quote unquote tax-free lump sum from a UK pension? And I'm sure we'll expand on this. One of the things to keep in mind for all of these topics we'll cover today is there is some degree of subjectivity and different interpretations. So we'll sort of share our thoughts there.
Before I hand over to Simon, I just want to say there's actually three. It's not just how does the US view it. There's three parts. How does the US federally view it? How does each state view it? And separate but very much related, how should you declare it, report it? How should you communicate with these various bodies? So it's a three-part question.
I mean, shall I start with the inevitable tax treaty? So the tax treaty between the US and UK is there to give us all comfort that whatever one country agrees to, the other country applies with. So let's think about this from a UK perspective. When you reach 55, you can take 25% of your pension lump sum, and that will be tax-free. Now, the tax treaty says that if you do anything with regards to your pensions, then it should comply and be adhered to in the other country, which in this case is the United States, which is absolutely fine. The United States have put there's something called a savings clause within the tax treaty, which kind of puts a question mark to say, well, does the PCLS 25% become an income generation, which is taxable? I'm not so discomforted with that one. I think that the PCLS 25% tax-free is going to be treated that way for the tax treaty. So the savings clause for me doesn't really get in the way of that. However, what the US have stated throughout their own workings is the fact that despite the tax treaty, they see that any form of pension income is taxable. Now, you can argue, well, if you are the recipient of PCLS, where do you rely upon evidence to say you should report it and pay taxes on it? Should you rely on the tax treaty or within the code itself? My argument, you should rely on the tax treaty because that's what it is there for. But there's always going to be an argument from the IRS to say, well, hold on a minute, because we only agreed to the tax treaty. And this is something that I read upon maybe 3 weeks ago, and it's just only popped into my head, whereby the treaty does say that as long you can get the treaty credits and deductions, as long as that it's not to the max, it doesn't exceed what you would have got in the United States. So where does that play us? Because if you make a contribution of a pension, as long as you make a contribution to a pension of, let's say, 40,000, and you would have got that 40,000 allowance in the US, no problems. However, if you put something or receive something into a pension or out of a pension that exceeds what you are ordinarily allowed to take, then the IRS may take umbrage with that. And I'm just going to give you an insert to this, whereby they talk about taking money out of pensions, and they call it non-qualified distributions, which can be taken at the age of 59.5, but it would be subject to 10% tax. And this is what the bit I was talking before off air is, where would that apply then? So if the tax treaty is saying you can get this tax-free, this 25%, but then the IRS say you should only get this distribution at 59.5, well, hold on a minute, you're 55. So can the IRS really argue the case? Right now, what I'm kind of saying to everyone is, yes, rely on the tax treaty, but you should expect somewhere down the line some challenge from the IRS. And
you should expect.
I think so. If you get an audit, if you get an inquiry from the IRS and they look at your 1040 and they see, and they ask you for 8938s, they see all this money coming into your account, and then they question to say, well, where do you go from this? I would, and expect is probably a strong word, but it's meant that way because I want you to get evidence. If you receive this 25%, you should document as much as possible the tax treaty, the dates in which you received it, and the references, and even get a tax professional to say, yes, per the tax treaty, we believe this is going to be tax-free. And that's where I'm saying you should expect it, because even if you don't get the inquiry, you should have that supporting documentation just to give you two things, comfort and confidence.
Well, arguably, you should be specifically disclosing it on 8833, right? You should be taking a treaty-based position.
Yeah.
And that's in addition to the other informational forms. And just on while we're talking about, so maybe you should anticipate an audit. Better to be pleasantly surprised if one doesn't occur. But another super important point here, I think, is about getting this right is how long back do you have to worry? So then we talk about statute of limitations, which is typically 3, or I think more relevantly for this, 6 years, because it's involving international non-US income. So it's 6 years, or it's 6 years, or it's forever. Because if you don't file the correct forms, H938, maybe 3520, 3528, 8833 treaty-based position. If you don't file the right forms declaring it, then that potentially leaves your tax return open forever. So in theory, hopefully not in reality, but in theory, 10, 15 years later, the IRS could come back and say, oh, we see 15 years ago, this big, explain this. So it's not just about getting the forms right at the time. It's getting the forms right so you get that clock ticking.
Yeah. And I would agree. Typically, you should be looking after maybe 2-3 years. That's an ordinary investigation, and you should have everything prepared. And let's be fair, 2-3 years is not that long. But I would argue if you are doing something in 2 or 3 years, you should be organized enough for that to be kept and maintained enough for it to be there forever anyway. So going back to the point of, well, how far could it go back?
I think there's an exception to the 3-year limitation. So if it involves underreported foreign income by non-US income by $5,000, which is more than that someone's PTLS will be, it extends the statute to 6 years. But
yeah, and there's the fraud aspect, which is then unlimited. So it's unlimited because if you have accounts in another country, in the UK, for instance, where you've not documented a pension by mistake, well, then they could say, well, that's fraud. And therefore...
That's a stretch, though, isn't it?
Do
they do this?
Money, haven't you? You've got assets that you've not reported correctly. So, yes, it's a stretch, but I think it goes back to the view of the IRS to say, well, you've not told us exactly, you've not provided us with sufficient information for us to do an audit properly, or you've taken a view of purposely not disclosing it for whatever reason. So yes, it's a stretch, but I think it just goes back to a point though of, whatever, and I say this to my clients, is like, you shouldn't worry too much about how far back the IRS should go. I think what it should be about is, have you documented this year's return and next year's? Have you got a process? And I actually like your phraseology, without a plan, right? So you need a plan in place for your tax returns as much as anything else to say, we are going to put in the maximum amount of disclosures in here and just protect yourself. So get it right first time, and you don't have to worry about what year has come up because it's just there. You should be able to hand it over to them.
Yeah. Can we also just have a minute to talk about everything we're talking about here is federally, so it's unclear federally, but there's different rules apply at the state level, right? So most states follow the federal position. So if you're taking a position federally, then most states will follow that. But there are a handful of states, California being the most notable one, that disregard the federal treaty, which blows my mind. How the federal government can enter into a tax treaty and the states can just disregard it. But whatever, that's classic California, I guess. They just disregard it. So there's a strong case, I believe, that PCLS is taxable. The tax-free lump sum is taxable in California and maybe in other states as well.
Mm. And I think that's a fair argument. I think it goes back to a case-by-case basis. Where are you situated? When did you take it? And looking at the situation. And that's why I said about documenting it as much as possible, because it's where you are now. Because the view would be, well, what if you moved from Florida, whereby they're a little bit more, don't want to say lax and easy, but they're a little bit more,
easy going.
Yeah, exactly.
Also
great,
crazy, but
then you move to California the next year, and then California say, well, what's the situation here then? And then they dig deeper. You haven't got that prepared. Then you're still going to be in the hot water, aren't you? So and again, it just goes back to that whole point of just get it documented as maximum level of detail as possible. It sounds anal, yes, but so what?
No, it's not. I mean, I don't think there's any such thing as too anal in the US. I'm just going to summarize, and so correct me if I'm wrong on any of this, but what I always say to clients, and I've got you on this call to cover me on this one, but I just say, look, it's not clear. It's not settled. We rely on the treaty, and the IRS have taken there is some IRS communication out there that says they perceive it to be taxable. That's not settled law. That's an opinion from a while ago, and there's other opinions and strong opinions, but it's not settled. And I could Google right now, and I could find a tax attorney who basically says, oh, it's taxable in the US federally, and anyone who says otherwise is going to jail. Almost literally. I'm not being hyper, but he's that extreme. I could also at the same time on another browser pull up another blog from another tax attorney who literally says in his blog, you are stupid if you pay. You're an idiot if you pay tax on this. You've got to just disclose it properly. And so they're the two extremes. You're going to jail and you're an idiot if you pay it. In the reality, everywhere else is the middle. 95% of tax advisors don't even know about it, so have no. This is you bring it to their attention will be the first time they learn of it. Cross-border experts like Simon and people take a more nuanced view. Most, but not all, in my experience, are prepared to treat it as. Am I still there? Screen just went blank. Sorry. Tax-free but it's super important that it is reported correctly, multiple places. So as Simon says, to make sure that audit trail is strong. Okay.
We very often, I don't think it's uncommon that we hear from people each and every week who prepare their own taxes or potentially have a local, US-based CPA who is not going to know how to, generally speaking, who is not going to know how to invoke treaty protection and file those things correctly. So you absolutely want to be sure, no matter what position you're taking, as Simon and Richard have said, you want to be proactive and document those things wherever possible and in advance and maintain those files.
It's an act of madness. An expat filing their own taxes is honestly an act of madness. There are the good cross-border experts who cost a lot of money, but there are also really good ones who, more expensive than going to Bob at H&R Block, and definitely more expensive than using TurboTax. But those are a false economy. If you have foreign assets, foreign bank accounts, it's an act of madness doing your own taxes.
Perfect. Anything else to add on the PCLS tax-free, or should we jump to the next topic here? Just a reminder for anyone watching, if you have any questions, if things come up as we talk here, don't hesitate to send them through the chat. We will see them on our end. We're happy to chat through them as they come in. I want to jump to another fairly common topic. And this has to do with capital gains from the sale of a UK property. So fairly often we work with or hear from expats who are living in America. They might be green card holders or US citizens, and they have a property back in the UK. Maybe they've held it for a while. They're looking to sell it. They have some capital gains. They want to be sure they're reporting correctly. Any thoughts on how to do so, Simon?
Yeah, I constantly write articles on this point, actually, of timing of moving to a country versus the disposal of your home. And I'm actually going to think about Brits moving to America, but then Americans moving over to the UK, or Brits moving back to the UK from America, because I think it's something that you really ought to know and think about. You don't know what might happen in the next 5-10 years. You might decide to move to different countries anyway. So let's think about both taxes here. So in the UK, we have something called a private residency relief, which basically means that 100% of the time that you lived in the property will be tax-free. So if you, let's say that you had a property in the UK for 10 years, then you move to the US, and they have this extra 9 months as well, so which is a nice bonus. So it's the 100% of the time plus this lovely 9 months. What that basically means is you can move to the US, and within 9 months sell your UK property, and you will not suffer any UK capital gains tax at all. So that's nice. Now, what happens if you move, and this happens a lot to my clients, they move to America, they forget or don't bother to sell their UK property, and it's their home. They rent it out for a period of time. What will happen is then capital gains tax will be apportioned based on the fact that you have left the property, so 100% of the time, plus the 9 months. So let's say you've been in the US for now 3 years. So 2 years and 3 months will be taxable. And you would have to pay UK capital gains tax based on the disposal of that property. And you would have to do that. You would have to pay over the amount to HMRC within 60 days of disposal, which is really important, because when people sell properties, they think, well, okay, I don't need to report it until my self-assessment, right? Not true. You have to do a 60-day reporting for selling any residential property.
Wait, Simon, should I just jump in a second? So this is, we haven't even got to the US yet. This is a US resident selling a UK property when capital gains tax is due because they've not lived in it for past that 9 month period.
Yeah.
They have to report it to HMRC within, what was it, sorry?
60 days.
60 days. Not reporting it. I didn't even realize I had to report it, but not reporting it is a big problem. Waiting until your self-assessment is a problem, because then you're late as well. Oh, wow. Okay, right. I didn't know that. Yeah.
So then let's think about the US. And then I'll just use the same example going the other way around.
Simon, sorry, before you do, sorry. So we're in the UK, you're a non-UK resident, you still have to, because it's a UK situs asset. You have to report it. You have to pay some UK capital gains tax you get an allowance, right? You get the $3,000 allowance or whatever.
Well, you get 6,000 for this year, 3,000 next year. It's going to go down, and there is question marks whether they will follow Canada and Australia, Spain to add that. Well, not Spain yet, but they are talking about it, moving it to income tax levels, which will be interesting to see if they push ahead with that.
Canadian capital gains tax is income tax levels.
Yeah, they push it on income tax.
So if you sell a business, at one-off, you get taxed at income tax levels.
Yeah, but there are nuances in regards to the levels of discounts you get, so it's not as bad. But I'm just focusing on residential property for a second, and that's not different to Australia. You mentioned Australia right before, so I just thought I'd throw that in. So let's just cover off the subject of you've moved over to the US now for 3 years. Okay, why is that a problem? Because what the IRS code says is that you can get something called a home exclusion amount. Now, the US exclusion is $250,000 for a single person, or $500,000 for a married couple. Now, the problem is what if you got a gain of $1 million equivalent? Well, you will have to pay capital gains tax to the IRS, even though, let's imagine that you actually sold your UK property and there was no UK capital gains tax because of private residency relief, your exemptions, etc. But in the US, that's not always the case. If you go to the US and you've got a big gain, let's say you've lived in the property for maybe 10, 15 years, you go to the US, you become a US tax resident, you could have a major problem with capital gains tax, because they will only give you $250,000 as an individual and $500,000 as a couple. Everything else would be subject to capital gains tax.
Simon, sorry, but would you even get that allowance if you're not living in that property? You've left that property. Will they give you that allowance because you lived in it? Like the
tax
UK?
treaty pretty much specifies that whatever you had, so you still get this home exclusion. But what's really interesting, and that brings me on to the next point, because to get this home exclusion, you have needed to have lived in that property for 2 of the last 5 years, right? So let's say that you lived in the US for now 6 years, you won't get any home exclusions at all on that UK property. You still might get some home kind of private residency relief in the UK because they'll portion the time over from the start to the end of you selling the property. In the US, not so. You only get 2. You have to have lived in the property for 2 of the last 5 years. Otherwise, you do not get any of the home exclusion amounts at all.
Simon, that's going to be more common. People, I think, in my experience, people have moved here and then they think, oh, everyone comes here with a 2-year time frame, and then everyone either goes back or stays, oftentimes forever. Not always, but oftentimes forever. And at the time they start entering retirement or thinking about retirement, which is when we start speaking to them, they're like, "Oh, I've got this property in the UK. I think now I know I'm going to say I might get rid of it." Yeah, and they usually, they've been here for a number of years at that point. So and we've not even talked about FX, right? Because currency. Am I right in thinking not only do you run the risk of losing any exclusion for having lived in it, but am I right in thinking as well that the FX can have a huge impact, because when you sell it, the US will want to know the US GBP exchange rate when you bought it versus the US
when you sold
GBP exchange rate when you sold it. Now that can minimize, that can make some gains smaller, but I've seen some awful situations. Yeah, I've seen some awful situations where a relatively inconsequential pound gain has become a very substantial dollar gain, and people have had to pay this tax, and they've been totally blindsided by it. Yep. Totally blindsided by it.
You could conceivably have a pound loss, right, and a dollar gain on one transaction. That's a real.
Yeah. I mean, you could. The thing about that is you could. I purposely want to think about going the other way around, if that's okay with you guys, because I think what I'm going to say next is probably worse. So let's imagine that you're British and you move over to the US. You buy a home in the US, and then you move over to the UK. At what point do you sell a property? It goes back to the point of, well, hold on, I'm going to be back now in the UK. I'm going to sell my property, right? I'm going to sell that property, and I'm now in the UK. Now, the IRS have got some other punitive taxes called FIRPTA, which, if you're not careful, you could be subject to 15% withholding tax on the actual value of the sale. So you have to be very careful when you think about disposing of property, even kind of your home, moving over to the UK, because the buyer's attorney will say, I insist on holding back 15% FIRPTA because you are a risk. You are now in the UK. You don't have to do US tax returns, and we could be penalized if we don't withhold it. So we'll withhold it for you. So straight away, you got 15% with FIRPTA to think about. And there are ways around it, but I need to highlight that it's there. So then you go over to the UK, you sell your property. Again, if you're in the UK for more than 5 years, well, if you don't meet the conditions of 2 of the last 5 years, you miss the home exclusion amounts. So that could then be subject to full gain on your 1040. In addition, where you go to the UK, there's going to be other issues of capital gains tax as well that you'll face here. So you can see how deadly not taking planning steps, and I'm trying to use your phraseology here, but if you don't plan ahead, you could be devastated by the capital gains tax, not just in the US, but in the UK as well.
Simon, this is actually relevant for the Roth point we're going to talk about in a minute. The need for strategic planning with coordinated strategic planning between finances, taxes, because in my experience, tax professionals, even the good ones, are often looking backwards. Financial planners are often looking forwards, and the need, and so the communication required to plan for and overcome and meet these obstacles head on is so important. James, I'm just conscious that we were asked a specific question about this, so I just want to pull this back to the question. So, if I remember rightly, we were asked, they bought the house in '83.
Mm-hmm.
Right, I'm going to sell it now. Mother had lived in there for a few years, so they ain't going to get. Well, my interpretation of this is there's not going to be any, not going to get any exclusion in the US. I think at the most basic level, I think we've even been asked, do I need to report it in the US? And the answer to that is an emphatic yes. And this goes back to the original point, or not the original point, but a point we always make. If you're a US person, US citizen, US resident, alien, green card holder, you are liable for taxes on your worldwide income. Worldwide. So any income that comes from anywhere, US or otherwise, UK state pension, selling a property, whatever, that's reportable in the US. I'm still gobsmacked by how many people think income is not.
I want to add something else in there, because you was quite shocked about Canada trying to push everything on so income tax, not capital gains tax levels.
Well, Biden proposed that. I mean, Biden proposed that. I mean, I'm a big Biden fan, but he did. That was proposed here.
Yeah, but it is though. So let me just tell you this snippet of an example that I saw recently. So someone, funny enough, in my neck of woods moved over to the US. And I think actually they moved to California. So they moved over to California and they stayed there for about 8 years. And they talked about coming back to the UK, and they said, well, I've got this UK property. In order for me to move back, I want to sell the UK property, have the money in California, and then eventually I might buy another property in the UK if I move back. Can you give me some indication of the tax issues? And I said, well, you're selling your UK property. And he said, yes. I said, well, fine. Private residency relief you'll get. So the same example, but he's been renting it for the 8 years. So yes, he will get some private residency relief in the UK, but none in the US. Furthermore, he has rented it out. So why is that an issue? Well, the US, when you do a tax return, you have to show that you have a property and you have depreciated that property in your 1040. Even if you chose not to depreciate the property, when it comes to capital gains tax reporting, what they'll say is, we'll look at what you should have reported in your 1040 as depreciation of the building, and we'll add that back. So what we'll do is any gain that fits in that side, that depreciation amount, that will be a taxable income, not a taxable capital gain. So if you have to be very careful.
Right.
About
sorry. Can we
property.
just? I had a client get caught out by this. They moved back to the UK and were renting out a property in California. So you have to depreciate property in the US, but you don't in the UK, right?
That's right. We can't in the UK, to be fair.
You can't. So you have to. And it's not an option. You have to in the US.
Well, put it this way. You ask a CPA, do I need to depreciate this property on my 1040? And they say, no. However, because most times you don't pay income tax. If you carry out the right tax strategy on real estate property when you're doing investments, it's unlikely that you pay any income tax at all if you do it right. So this whole thing about taking depreciation is sometimes a bit of a misnomer. It might not be an impact. So you might not declare it, but when you come to sell it, the IRS will clearly demonstrate on their code. We will still look at this depreciation, and they call it depreciation recapture. So depreciation recapture, what would have been deemed to have been taken in your 1040 will be now recaptured and then added to your taxable income equivalent to that deemed amount. So you may not have even had any benefit at all, but now you have to put it on your income. And the reason why I'm mentioning this is because it's quite deadly for Brits moving to the US and then saying, hey, I'm going to rent out my UK property. Not always a good idea, because you will have to take this deemed depreciation.
My head's hurting a little bit here, but so if my head's hurting, it means anyone who's listening is their head's hurting. But even if you don't depreciate your property, when you come to sell it, they will add that back on. Even if you didn't, they'll just add what they consider the deemed amount.
And they actually call it that, the deemed depreciation amount.
Even if you haven't claimed it?
Even if you
on a yearly basis?
Yeah.
Oh my God. All right. Okay. All right. Well, I repeat what I said a minute ago. This is the importance of planning and having a tax advisor, a cross-border tax advisor. It really is a strategic. No, I'm going to add to that. A strategic cross-border tax advisor. You need a strategic cross-border advisor who thinks.
The problem is that there's so many levels of income streams that you could have. You could have a business. You could have employment income. You could have assets. You could have pensions. I mean, there are so many issues when it comes to reporting to the IRS. But back to your point, if you're using H&R Block, I don't have any issues with them at all. But they will give you a standard carte blanche approach. They will not give you any proactive tax advice. They will not say, this is your tax. You can minimize it by doing this instead. And that is the thing that you need to bear in mind. You may pay $500 to get a tax return done. Brilliant. You've saved a lot of money. But how much money are you actually throwing away?
Simon, I think for me, it's more important even than that. It's not just that's the icing on the cake, is having a strategic tax advisor to help you do stuff. It's the base level is just these guys don't know about FATCA. They don't know about informational return. A lot. I don't mean to just. I know many do, but a lot don't. The amount no one files 3520s for foreign pension trusts. Well, that's not good, and that's almost universal. So it's more. It's what you're talking about is cherry on top, the icing on the cake. It's more fundamental than that. It's just avoiding the landmines. Yeah. All right. Sorry, James. I'm getting a bit carried away.
No, that was good. So I think, the takeaway for the gentleman who sent that question in, engage a cross-border tax advisor who is aware of these issues.
Yeah, but before that, to answer the question directly, yes, it's reportable. Yes, it's going to be taxable. I wouldn't expect any. Maybe in the UK, I don't know. It depends on stuff, but definitely, certainly in the US, which is where we're mostly concerned. But probably in the UK as well, if there's a gain.
Well, to be fair, and this is the issue. If you are a UK resident, you only have to report HMRC to disposals if you have a gain. If you're a non-resident, you have to declare it even if you don't make a gain.
Really?
That's interesting.
Huh. There you go. A lot today.
So I know we're pressed for time here. We had sort of an open-ended topic we can quickly touch on. A lot of this is going to be based on facts and circumstances of your own financial plan, but we often get questions regarding Roth strategies for Brits in America, and maybe more particularly Brits who are in America at the moment, but may or are actively planning to move back to the UK in 3, 5, 7 years. Any thoughts there?
Do you want to start that one?
Yeah, specifically, we've so one of the key features we've looked at. Someone comes to us, they're 5 years from retirement. They're interested in moving back to the UK at some point after retirement. There could be a strategy of implementing systematic Roth conversions of pre-tax assets while they're living in the U.S., effectively locking in lower U.S.-based tax rates. They move to the U.K. They now have these Roth assets, which, not being a tax advisor, our understanding is that they'll be treated as Roth distributions, and thus you won't be paying that higher UK tax rate once you've moved back. No. Is your understanding along those lines, Simon?
I want to go back to the tax treaty because it really does define whatever happens in one country happens at the same time as the other country. That is what the tax treaty is all about, especially when it comes to pensions. So if you're contributing to a pension, an employee-based pension, and you have a deduction in the US, you should have the same deduction in the UK. If you're, on the other hand, though, if you're investing in a pension that you don't get tax deductions like a Roth that we allude to in the US, then you wouldn't get tax deductions potentially in the UK because the treaty treats them the same thing. So you need to be a bit careful kind of how that works. Now, the question that I often ask people is which way should you do it? Because I saw another YouTuber talk about pensions, and he's very controversial. I'm not sure I would kind of approach him for my advice, but he talks about tax planning and regards to if you are paying low amounts of tax now in the US, putting money into a pension or any other investment that gets you tax relief may actually be the wrong thing for you to do anyway. Because if you are going to be retiring soon after, let's say 5-7 years time, and you're going to be on a higher tax bracket, you would have been better to have not taken to made the contribution to your pension now, Roth, and not have that tax efficiencies in the early years, but get it afterwards. So I don't know what your views are on that one, because it kind of plays on my mind every time I see his channel in terms of what people make for investment decisions.
Yep, absolutely. It's if there are periods of essentially, common situation for us, someone's consulting part-time, they may have a very low effective tax rate. And at that point, you're better off, you're in 12% bracket. Maybe you want to take advantage of Roth contributions, whether that's an IRA or a simple 401k or whatever your employer is offering. And more importantly, and not that you might have been getting to this, Simon, but if the option is paying a lower rate in the US using Roth, and you're avoiding eventually taking distributions in the UK at a much higher marginal rate, you've obviously, the capacity for savings is even more, right? Because the difference between US brackets and UK brackets can be significant.
So it could be a situation where we have a client who, if they were staying in the US, we might not recommend a Roth strategy, or at least not until they were, if they retired early. But we might not, because the marginal gain might not be worth it. But if we knew they were going back to the UK, it might be worth it still, because the tax rate in the UK is going to be 40 or 45% versus 27%, right? That's an opportunity. But as with anything, where Roth's concerned, the more time the better. Right? Yeah. You come to us and you're like, oh, I'm going back to the UK next year. I might not be. We might not have options. But if you give us 5 years, 10 years, a lot of planning can be done.
And it's very much a case-by-case basis, and not just for the individual, but actually the timing of when they're going to make the investment and what their future looks like. Because right now, I think what most people try and do is say, well, and the nice thing about the US tax situation is you could be in March and make a pension contribution and get that tax relief, right? So that's kind of nice, because you can, even though the tax year end's gone by, you can still make that contribution and still get that tax relief. Yeah, you can't do that in the UK, right?
Yeah.
So you have to be very you can be quite savvy in the US. You can't in the UK. It's kind of done and dusted.
It's as a financial advisor, it's very hard, that one. Because when you grow up in a system, you like turning right in a red light here. Like every time I approach a junction, my initial reaction is not to turn right on a red light, and it's a bit like making a pension contribution after the end of the year. It's like, we've missed it. I have to override my instinct, which is like, you've missed it, it's too late. Don't do this, otherwise, it's an unauthorized transaction and additional tax. I think it's a great thing, and I wish the UK did it, but my training kicks in. My instinct, which is
the UK side, yeah.
Was there anything else on the Roth one, James?
No, I think, like I said, it's a bit open-ended, much more subjected to personal facts and circumstances. We touched on Roth conversions. There's also backdoor Roth, mega backdoor Roth. There are all these plans that, again, I think the common theme here is proactivity, either, exploring these things yourself, or, biased opinion, engaging an advisor who can help you walk through these and their potential fit into your plan. For our audience, expats in America, there can be some pretty significant savings if that's something in the plans moving back to the UK.
I sometimes feel that people get frustrated with us, and honestly, when I first moved out here, I got frustrated with it. Everyone just says, "Oh, speak to a tax advisor." And one of the reasons we do this is we want to answer questions, shed light on these topics. But we always, I'm like a broken record. I'm constantly going on about to a tax advisor. Now, I'm not a tax advisor. Plan First Wealth is not a tax advisor. I have no skin in this game other than better outcomes for our clients and British expatriates, making the most opportunities, avoiding the landmines. I don't know how you do that without a tax advisor. Even with a tax advisor, it's very possible that you're going to encounter landmines. But then you have the cover of, I have a tax advisor, they're qualified, I shared everything with them, I relied on them. It's huge cover. Huge cover. I just urge everyone, consult with a tax advisor. Not any tax advisor, a cross-border tax advisor.
But I just want to echo your other point there, Richard, because you talked about tax returns and cover. But what about the planning side? You know, it's more to do for me is you can't change the past. This is Anthony Robbins saying for all you coaches out there. But you can't change the past, but you can certainly, you know, your past doesn't equal your future. So if you know you've not done tax planning in the past, don't make that same disaster next year.
Simon, I have an idea for this, which me and James are going to run past you after this in private. So everyone else, sorry, we'll watch this space.
Yeah, I want to thank everyone for attending across all of our channels, and give us an opportunity here. So we are, again, James, Richard, and I, planfirstwealth.com. Our website is a good place to find us. If you have specific questions, join our Facebook group, Wealth Hub US UK, or you can email us directly. I'm James at planfirstwealth.com. Simon, if someone has tax questions, where can they reach you? I
think what's always is just visit our website, www.optimizeaccountants.co.uk. Optimize with an S, not a Z, just my own sanity. And also you can find us on YouTube. We have a lot of free information. We have a glossary of US taxes and UK taxes, so feel free to visit our website, but also on YouTube as well.
Perfect. And just a reminder for everyone, we do these monthly, so we'll see you on the second Wednesday of July. Take care, everyone.
Thank you. Bye-bye.